Good morning, everyone. Chin Yap from Singapore. Is that right? So, good morning, good afternoon, everyone. Thanks for joining our second session and welcome back. Uh, Great. So, we have quite a few people who have joined us today as well. And this is actually the the last session was more of an introduction, and so today is the kickoff proper of the entire program in terms of uh, anti-money laundering. So the introduction was actually for I did an introduction earlier so that we can get some an idea of the context of and also to gauge and how deep the understanding is in terms of in terms of understanding what the correspondent banking is. So today I wanted to start off with talking about customer due diligence, which I know this is a process that in from the beginning of time it has there's another terminology that is being used which is called KYC, know your customer, but a lot of us call it kill your customer rather than uh, know your customer. So, administration, please mute your microphones when not speaking and keep your mobile phone handy as usual. Use a group chat if you want, if you wish to comment or ask questions. And if you have any questions that you want to speak out, do raise your hand because admin has everybody muted so we can get you muted so that you can speak. And as with last week, the last session, we have the parking lot. And so for you to also put in your burning questions that you want to be addressed, and hopefully we are able to address in the next session. I do intend to have the first 5 minutes of each session to discuss or at least share some of the findings that I had from and before we kick off, and that's what I meant by co-creating the content. And the more questions that you have, then we will be able to get them in here as well, and to participate actively and have fun, and of course this participation certificate at the end if you complete 75% of the program. And so what we have here is the parking lot. I will have it available until the 21st of March so that you can continue to so that you can actually put your questions in. You can use the you can scan it, or I have parked the link into the chat box so that you can actually put that in. Do you have it? It's in the chat box, the link, or you can use the QR code. So right, so top the preliminary question survey that I sent out, I thought that was really good. Some of the questions that came in or the concerns that came in were really, really helpful. And so I decided that I'll put it and share it with everyone what the finding was from the survey. And we see that there was concern about digital technology innovation generally, and then there were quite a few questions, and actually, even when it comes to the voting, there were quite a few questions around identifying and detecting fraud and scam, which over this period, I hope to able to be able to share some of my thoughts around it as well. Um, and then, yep, the third question is actually quite interesting, which is on applying how we can apply the best practice over conducting due diligence checks and not over checking. This is what I meant by the know your customer. So, and so on and so forth. So, uh, yep. So these are some of the questions. You'll be getting a set of the slides so you can actually take a look at them as well. And yeah, I actually quite like that comment about compliance being a moving target. So let's see. And yep. what are the areas of risk that correspondent banking can be misused by criminals and all. So, and last week there were two parking lot questions. Um, First question is on whether ISO 200 2020 would help to expand correspondent banking, and should banks in the global south accept that US dollar is out of their reach and look for other currencies. I don't know whether there's anyone here who has any insight. Okay, let's talk about first. I don't know whether you agree with me. My thoughts on what ISO 222 can really do, and whether it will expand correspondent banking. My view is that correspondent banking is here to stay. It's just whether or not it's going to be through the banks or anything else. Nowadays we have the new payment methods. What ISO can do is that it provides a structured and data-rich common language that is readily exchanged between corporates and banking services, and this is extremely important in terms of interoperability of between different kinds of entities. It improves transparency and basically is the foundation for innovation, like moving from end-to-end batching, end of day batching, to real-time payment processing. So it basically provides an opportunity for enhanced analytics. So whether or not it expands, I wouldn't say that it would be an impact on it, but it definitely helps to improve the transparency and operation, to help the financial institutions and corporates operate more effectively from an operational aspect. And then so on. Is there anyone who would like to also venture a guess on whether banks in the global south should accept just US dollars out of the reach and look for other currencies? Any thoughts about that? I don't think that I'll be able to comment on that, given that this is more a macro situation rather than any than micro. Any thoughts? In any case, I think there is this other comment about or question about 10 years ago there were some 100 banks, more than there were actually quite a lot of them, offering US dollar corresponding banking, but now less than 60. So considering all issues, what specific action should a banker take? Now, I think from there are many factors involved. Many are interrelated. Cost benefit consideration following the global crisis was one of the reason. There were also stricter rules on tax evasion and tackling of financial crimes globally that require financial institutions to enhance their due diligence process um, at onboarding and ongoing basis, which is complex, costly, time consuming, and also labor intensive. And of course, the fear of large penalties and reputational risk from enforcement action. So, correspondent banking in itself is actually a higher risk product for the correspondent banks that are offering this. And so, they become very, very careful about who they offer to, and cost benefit being one of them. So, I think what we can do specifically, I would say that it's actually working together across the entire ecosystem to enhance our due diligence process, to enhance all our anti-money laundering program, and that will actually help to alleviate a lot of all these concerns that correspondent banks have. So, which is exactly why we are here today, is actually to talk about how we can look at enhancing that capability across the region, from knowledge all the way to processes, so that we can continue to look at how we can get correspondent banking back into the region. Okay, so last week we had a correspondent banking an introduction. So today we are going to have fundamentals of customer due diligence. And so, recap on module one, we talk about the international regulatory standard setters. We talk about how they drive the international regulatory framework as well as country primary and secondary legislation, then the rules and then the industry guidance. Like for example, you have the Wolfsburg Group being the fourth at the forefront in terms of establishing industry standards and best practices. And then, of course, then our institutions are the ones that would be uh, putting in our process and procedures to be able to manage to address those standards. And we have the FATA, that is the intergovernmental body. And then we have in our region, we have the Asia Pacific Group on Money Laundering. Then we also touch a bit about predicate crime. When it comes to money laundering, there is always a crime behind that crime, and that's what we mentioned. That's what is meant by predicate crime. And some of the more concerning ones of recent time would be your fraud and scams, which many people have put in the survey that that is a really big concern, and it is a concern globally, not just in the region, in Asia Pacific, but across the entire world. I would say, you can see, um, you can actually see how this would be able to. I'll be sharing a bit more about the fraud and scam as we go along, as I mentioned, because currently there's a lot of work being done globally with different alliances to manage this problem. So I see, Rajesh, you what you asked this question: what is your view on BRICS agreeing to a common currency and overtaking US dollar? Um, I think it gives us another option. That would be my personal view. Um, when that is going to happen, it's probably I think it depends on the speed of how this is going to be implemented. I know that in ASEAN there was a time when there was an attempt to do so, but it didn't work out. Euro was successful. And then so I think the mechanics of it will take time, and in the meantime I would say, we will have to focus on what we can do at the right and within our control. So, and while we see how this takes on, I can see there are other alternative currencies that are being used as well, so we probably have to watch this space. I can't really comment too much on whether this is going to work or not. um but I hope that it does, and it offer us an alternative. And but then of course it will also depend on how many countries are going to make use of it and how extensive it's going to be applied. I hope that answers your question, but I think that is a great question. Something looking at alternatives. So, and you mentioned that it is not a victimless crime, money laundering. So that's why it's so important for us. While I know in the past, I don't know how many of you here are actually compliance officers, and I've always been in this position where when the relationship manager explains to the client, they will say, "Oh, um, this is actually not my fault. It's compliance. They are the ones who are really being a pain, and so they basically blame compliance for all the pain that they are going through with with the customer due diligence or the KYC." So, and a reminder about the key anti-money laundering concepts, where we talk about placement. The first time when it first get introduced into the ecosystem, the financial system, is the placement. Then you do the layering and you integrate it, and then uh, the other concepts are about customer due diligence, identifying suspicious activities, and risk-based approach. So there was a question in the survey about, how do we make sure that we are striking a balance, that we are not overdoing the checking. And this is we will touch on the risk-based approach later as well. And also reminder about the what the common correspondent banking structures look like, which we shared the last session. and what it looks like as well. This is on the cross border, very simple. And what are the risks in correspondent banking? So, correspondent banking, the correspondent is actually relying on the respondent to be able to do all the due diligence because they have very limited information and unable to verify their identity. So generally, that's why there was this Wolfsburg questionnaire, the customer due diligence or the correspondent banking to CBDDQ due diligence questionnaire that was introduced by Wolfsburg is actually to be able to drive some good standard on how we can do assessment, risk assessment on our respondent banks, or I call it the FI client of the FI. Um, so that you're able to assess the risk and whether or not the robustness of the respondent bank. I've actually come across some where um over this period of time, I'll share some of the anecdotes that I actually collected during my time doing correspondent banking advisory, where sometimes it's not just as easy as saying do what you need to do and tick the boxes and all that. There are instances where it goes it spans further. As an example, I remember I was at that time, I used to work in Dubai, so I'm quite familiar with the Dubai environment and the geography there. So I went to a country in the Far East, and then we had this conversation with the trade finance, actually not trade finance team, it was actually the compliance, trade compliance. And so I asked the person, so how do you ensure that there is no transshipment? And for those of you who are not familiar with transshipment, it actually means that you stop the ship and then you do uh, in the middle of on your way to your destination, you actually um, stop halfway and do other activities as well before you move on. Either you bring more things onto the ship or you unload things. So one answer came and say, well, if it goes to Middle East, it's very easy. We just check that it doesn't go to Iran. So because during those days where you don't have all this online and real-time tracking of ships, you have to use the International Maritime Bureau reports. And because it's IMB reports are quite expensive, they say it's on a risk-based approach. And I say, how do you look for it? And they say, oh, well, we check to see that this is not. And anyway, most of all the ships go to Jebel Ali. Jebel Ali is not in Iran. So I'm like, okay, fine. But what people did not realize that it's on a clear day. You can possibly see Iran on the opposite shore of Jebel Ali, and it's just few hours of fast boat and you reach Bandar Abbas already. So that's the kind of so it's not as simple as just ticking the boxes, but also understanding the geography. And that's where training comes in. It's actually to get people to be aware of what is out there, is about thinking outside the box. It's about actually not in this particular instance, it's knowing the international environment as well. So where that's where having our team to be familiar is important. And breaking down the challenges further, we this is a recap for those of you who are here. This would be a recap of what we see the challenges are: regulatory compliance, and then you have the high cost, data privacy. I think the challenge right now is also on the rise of fintechs and innovative payment methods. And as we also talked about, is the expectations of the respondent is to be transparent, is to have a clear, open communication, to be prompt in responding to the request for information and understanding the institute's risk appetite, and whether or not it's on the correspondent side or on the respondent side. Okay, so this is a second poll that I'm launching, and I thought that it would be good for you to I would like to understand for you all of you who are who are actually here, I want to understand how many of you are familiar with the customer due diligence, not correspondent banking this time, but customer due diligence. So, because I think understanding your where you are would help me to also see how fast I can go. Okay, I see the. Okay, so quite a lot of you are. So 44% so far is actually 44% is showing that 50% now is showing that you are familiar. So right, okay, this is the composition of it. So do feel free to put your hand up to ask any questions if for those of you that are not so familiar with customer due diligence process. Um, and I'll try to uh, balance out, the speed of it as well. Okay, great. Okay, so next, so what the learning objective of today's module is we first touch on the concept of customer due diligence and then broadly look into the processes and even some of the tools that we use. Then the building blocks of effective due diligence is actually talking about first when the customer walks through the door, how how do you determine whether you want to onboard the customer? And then once you have successfully onboarded, then assuming a happy path, then it goes through for ongoing screening and monitoring, and these are actually the building blocks of effective due diligence. In fact, nowadays there's a term called perpetual due diligence. Will you will touch on that a little bit in this session as well. In fact, some consultants have coined the term FRAML, which is fraud and anti-money laundering. And so it's quite interesting how the fraud and money laundering has actually converged into what we now call as FRAML. The skill sets are different, so I am not so keen on using the term FRAML, but well, it's up to the individual appetite as well. So, right. Okay, so this is a question. This guy walks into your business premise. What would be his risk rating? Maybe I can get some. I give me what you would think when this guy walks through your door. Uh, what do you think his risk rating is? Anyone on the chat? You won't be able to actually see if you don't have any of his documents, right? You will not actually be able to see whether this is a person that you want to onboard, correct? Because it's a face and you don't know. And of course, he doesn't have he's not one of those famous persona like Donald Trump or Madoff and all that you actually know whether or not you want to you you want to onboard the person. So yeah, see, Sean Krishna says depends on his KYC documents and other details. So I mentioned about in Singapore, August last year, where now and still counting, 3 billion worth of Singapore dollar, 3 billions worth of assets were seized, and these were the 10 people that were arrested. And still hunting for some of there's a handman hunt going on for some of the other people. So this is the guy. Su Wenchang, age 31, holds originally from China, holds a Cambodian passport. So and he actually an executive in a remote lottery business operating in Philippines and Cambodia. Coincidentally, today I'm in Cambodia. I am conducting training later today, tar- and this is targeting gamblers from China. So now, when you look at when we talk about the when we talk about screening, right? So normally, what do? You would actually pick up his passport, and then you will do a screening. When you do name screening, you would think that because he holds a Cambodian passport and he'll probably be showing you a Cambodian passport, is that you wouldn't know that this person was actually blacklisted in China because the name may match, but the nationality doesn't. So these are some of the challenges that we face when it comes to customer due diligence. It's not so simple as just inspecting the documents anymore. There are other areas that we need to also look into to look into whether or not the person is a money launderer or actually somebody that has been blacklisted. And I think on top of that, is onboarding itself is just one part of the journey. It is the first line of defense, and after that, we need to also consider the ongoing monitoring, the transaction monitoring, and the name screening as well going on. Because today, the person may be a pet or doesn't have admissed media. Tomorrow, the situation may change. Yep. So and then David says, yeah, there's no way to judge, and two views is that everyone is a suspect and they must prove themselves to be legit, and the other view is that everyone is innocent until proven guilty. So we can use either approach. Thanks, David, for that. And yep. So we have quite thanks for all this feedback that's coming in. Yeah, actually, Chinyap, nowadays social media is a very helpful platform as well. Not so much just depending on the tools that we use. And yes, for sure, depending on the customer risk rating methodology or risk assessment on how, and also um and also I think the risk appetite, because different institutes will have different risk appetite. Uh, as far as onboarding a customer is concerned. So that's where it comes to, a lot of the international institutions have stopped offering correspondent banking to specific category of countries or jurisdictions. I love this slide a lot, and this was posted by Luke Raven. He's what I would call our LinkedIn influencer on in the compliance world. So he posted this, I think, probably last week, where this is how we think, that KYC is standard, but actually this is how it should be. So you can see that a lot of us think that, KYC is just basically completing all the checkboxes, and then and but then actually, everyone has a different risk profile. So I think this particular picture really depict KYC more accurately than anything I've seen so far. You can check out Luke's profile on LinkedIn. He shares a lot of interesting posts in a very fun way and easy to understand. And definitely one of my go-to person when it comes to bouncing off ideas as well. So right, and next is, oh no, I get this question a lot. What is people talk about KYC and you talk about CDD, and if you check even Chat GPT, when you ask what is the difference between KYC and CDD, it will give you different answers each time, and Google will tell you a different answer as well. So what I thought would be good is actually to also share with you uh, not to be too concerned about the difference between KYC and CDD because they're really the same thing. Um, what I remember is that in the early 90s, when first Know Your Customer came about, the concept of know your customer came about was when to make it simpler, people were, I mean, generally um you would say that this is um KYC, so that is a much simpler term to use. And then, over the years, the terminology has evolved to CDD. So customer due diligence is definitely more robust in that sense, because the due diligence goes deeper than just knowing who your customer is. And then uh, what I also felt would be um, someone in the compliance sector actually shared this. Her view is that KYC and CCD are the same thing, while where KYC is the what and CDD is the how. So therefore, they are the same, rather than to be too concerned about when is CDD happening, when is KYC happening. And so let's touch a bit about the FATF and also the FATF style regional c- uh, bodies. Is that we have this I sourced from Nota Bene, and we have actually in our region, all of us are covered under by the APG, and then also by the FATF. And just a reminder, I think all of us here would be aware of the high-risk jurisdictions, what FATF calls the blacklist, which are the three countries, the North Korea, Iran, and Myanmar. And in the most recent plenary, FATF plenary in February, so these are the countries that have been that are in the grey list, and of course, we knew that there are quite a few of them. Uh, that have actually been added on, and there's some taken off as well. So this is the most recent list in the grey list. And okay, so we are now starting with the customer due diligence proper, and which is on let's look at the two recommendations, FATF recommendation one, which is on applying a risk-based approach, and then the requirement of the recommendations 10 and 11, which is on customer due diligence and record keeping. So generally, in most of our organizations, um, we have three layers of three levels of customer due diligence. One is quite standard. Another one is simplified, which again on the risk-based approach, and then on enhanced due diligence. And why is that so? In the good old days, we will apply the same level of due diligence and do have the same amount of work uh, in terms of whether or not the whatever the risk rating. And this is not working too well, because you're actually putting energy for too much energy into the lower risk customers, and we start to lose sight of what to put not enough focus, I'll say, in the higher risk category of customers. So that's why the risk-based approach came about, where we look at, if it's a high risk, then we will have enhanced due diligence. So, some of the key elements of customer due diligence process, we have who are the people that we are doing due diligence on. So, generally, you will have the individuals, customers, right? And then you will have the legal entities. On the legal entity side, is a bit more complicated. You will have a foundation, you have the normal corporates. Then with the corporates, uh, you will have the public listed and not public listed companies, and you have the various type of legal entities. And then I generally break it down into three processes, where we talk about the onboarding. After the happy path, we we then look into making sure that we have the periodic screening, monitoring of the existing customers, and then ongoing monitoring. And then after that, the last part is actually on reporting. So that's what I meant by cutting it into the three broad processes. And here are some of the tools that we use. And we will have the tools like in our organizations. We have all these core banking systems, static data, transaction data. Then we have the onboarding process, and then we have the periodic review, and then we have the reporting. So we have in onboarding side, we have the client screening, we have the risk scoring. Then we also have, in fact, in the periodic and ongoing monitoring, we will also have the client screening that happens at the same time. We have the transaction screening, we have the transaction monitoring. So on transaction monitoring, we will have a module separately for that. And so we can have a lot more discussion around some of the questions from the survey as well. And I think it's important to be able to distinguish what's the difference between transaction screening and transaction monitoring. Transaction screening is actually about pre-screening, and we screen those transactions before the transactions pass. And that's where a lot I have been through it before, where I was transferring funds from UAE to Malaysia, and it got stuck where um, my funds, we usually take about 2 to 3 days to complete the transfer. The money didn't just kind of like disappeared into thin air, and I couldn't trace it because for 2 weeks, and it was actually because it was, I call it, stuck in the transaction screening because it was transferring from one high risk country. I mean, some banks that I went to actually classified both UAE and Malaysia in the high risk category. And when you have high risk to high risk category, it got stuck in the transaction screening, and it was subsequently released after multiple chases. And this is the kind of pain I think a lot of people us here would have gone through. And then and eventually it got released. It was a very, very painful process. Um, and I think, when we have the ISO 20022, it's actually going to help to make it easier um, for people to be able to actually do it faster, because there is actually real time, and then it is more robust in terms of data collection. And first, let's touch about identification and verification. So identification and verification, we first, what do? We actually would identify a person is that the person say this is who they are. And verification is to say, I confirm that this is who he says he is. So that's why there is identify the person first, getting the information, and then after that checking the information and verify that it's actually correct. And then there all these other verification, and if there's any, I think and then if there are any other additional documents that are required. And so some of the other ancillary activities that are involved in customer due diligence is also because of the tax requirement FATCA CRS, which has been implemented since early 2000, right? So these are some of the activities that got added in as well. And then on that, here we talk about the customer identification and verification, is also where we collect additional information, which will be used for our ongoing monitoring. Say, for example, what are you using the account for? What's the volume you're anticipating? What's the amount you're anticipating, average amount, and why is that important? Uh, I know that I used to think that it was such pain to get this information, and my customers think so too. That's also because sometimes it's very hard for people to gauge. But what I realized that when I joined the compliance side is when I realized that without this information, I'm not able to assess whether any transaction alerts that come out, I'm able to easily close it off and say, okay, so this person, um, the transaction is actually normal because this is what uh, these are the activities that he is using the account for. But without that kind of critical information, we it would be very difficult for us to make the judgment. And of course, a lot of times people may uh, understate their amount and volume. And that's where it gets hit again. It's like if I tell you that I normally would have my average amount is about $3,000 US, and then suddenly I have 100,000 US, and then obviously, it will flag out as an alert, and then we need to start investigating on that. So having accurate information from the beginning is important. Then name screening, as I mentioned earlier, name screening. Now we have the wonderful technology of social media as well, which is helpful. We have the rest of the other list, and of course, it's not foolproof, as we saw in the Singapore cases where you can screen the person, but the nationality would not match, and then you think that this is actually okay, this person, just the name is a common name. It's a common name with Chinese. I'm Chinese, so I think that this is quite a common name, and so I wouldn't have given it much thought about uh, marking it as a false alert because passport doesn't match. And then ongoing monitoring, this is the other process that we talk about. So when it this is the new terminology that has come out, which actually we call it perpetual KYC, is because as we continue to screen the names, continue to monitor the transactions, then we come up with a robust profile risk profiling of a customer, and that's where the perpetual KYC happens. And one thing that I feel very important is that we have in recent years put a lot more emphasis onto identifying beneficial ownership, because a lot of times all these people, they will not be going up to the bank and say, hey, uh, say for example someone with adverse media, I would say, would I come to you and open a bank account when I know that I could have been blacklisted? So they incorporated all these companies, trust company, foundation, funds, and all that to hide the beneficial ownership and to obfuscate, actually to to not be able to show themselves out, or to be easily detected. So that's quite important that we also look into the beneficial ownership. And so FATF recommendation 24 and 25, it talks about transparency and beneficial ownership of legal persons and arrangement. And so whether or not the ownership is an individual, is an individual, or the ownership is a share in the capital or the profit, or is a control right to appoint or decide. So I think this is where it gets a bit challenging, especially when it comes to certain kind of structures where it's a fund that's being managed by somebody. So do should we be screening the beneficial owners, or should we be looking at the investment managers, the one who's actually deciding where to park the fund? So who is actually having the ultimate control, and who is actually having the right, the ultimate decision making capability? So these are some of the concerns that we have when it comes to identifying beneficial ownership, and then also um, identifying who they are, in terms of and then how who is actually making use of these legal entities or hiding behind them. And the concept, whether or not they are acting alone or together, whether or not they're a natural person, they are controlling in ownership interest, or is a capital, or is it profit, benefit, or any of these concepts. So one of this very interesting thing is, in the beneficial ownership concept, we also have this terminology that we say unduly complex. What we mean by that is that, you say for example a business actually it's a very simple business model, but it has multiple layers, and some of the layers are actually incorporated in the tax havens. So it may be a raise for concern. So, or not so much of a concern, but we should ask more questions about it, rather than to just say, okay, there are four layers and they're all here, 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 and that's it. And the other thing about the beneficial ownership is that, of course, now a lot of jurisdictions no longer allow for bearer shares. Bearer share is where you have a share certificate that can be passed on from one person to another, and it's easily done so, where you cannot easily identify who the beneficial owners are. So this kind of model has since being phased out in most jurisdictions, and um, in terms of having issuing bearer shares, that's being phased out, but there are still a lot of bearer shares in the market which are legacy. And then uh, yep. So and then after that, what we have is, okay, as an illustration, what do you mean by beneficial ownership? Is like any corp, for example, who owns any corp? So you have any corp limited that is owned by any corp holding limited, that 100%, and then person A owns 60%, and then person B owns 40%. So that's generally what beneficial ownership is about. And then companies. So typically we have what do you mean by controlling ownership interest? So generally in a lot of jurisdiction, when we talk about substantial ownership, it would be more than 5%. Some jurisdiction may say 10%, and controlling ownership typically is 25%, but again, it really depends on the jurisdictions we are in. Um, Whether there's a right to appoint majority directors, and all that will all be in the memorandum and articles of association. So that's why memorandum and articles of association are documents that are really thick, and usually nobody pays too much attention to it. But you'll be surprised the kind of information that is contained there that we can use to actually identify who the owners are and what kind of controls that they have, or the powers that they have, or the authority that they have. So to me, that is extremely important to actually have a look at the memorandum and articles of association. Um, so then, wait, and another illustration. So ABC Inc., we have all these people who are uh, owners, individual owners. Bob Smith, Sue Smith, John Doe, and Mary Doe, they are individual owners. And then Doe LLC actually owns 20% of ABC, and Doe LLC is owned by John Doe and Mary Doe, 50% and 20%. And and then the other and then after that we have the other what do you call it? Then the other 30% being owned by somebody else. So indirectly, John Doe and Mary Doe owns more than just 20% of ABC. So that's what it is. And then the beneficial ownership, this gets more complicated. You have the UBO Inc. that is owned by Rockco, Holdco, and offshore fund. So each of them own different um uh, how many percent of it. And then after that you have Steve Rogers, and then you have the family Holdco that owns. So you can see that it can get more complicated than this. And when there is more complication, and when you see more shareholders, corporate ownership or legal entity ownership in there, is where what we term as unwrapping. Unwrapping is where you unwrap the structure and to understand what is behind it, who is behind it. So that's what we term as unwrapping. Um, Hang on. I actually have. I see that there are actually some questions here. Okay, so there are a few questions here. Chin Yap asks, with the eKYC as mentioned just now, do you think an additional step or authentication is required besides identification and verification? Yes, Chinyap, actually, yeah, eKYC poses its own challenges as well, whether or not the person that has put the, because it's not face to face. When it's non face to face, you pose another challenge whether or not the person who actually loaded the document is correct. And so from there, we would require a liveness test. We get the customer to take a video live. and just to see that the person is actually the same. This is to also prevent synthetic date, what do you call it? Synthetic identity, as well as account takeover as well. So, Raja, as you mentioned about control other means, okay, yep, correct. OECD requirement is that bearer shares are not acceptable, and it's also quite recent. I would say quite recent in the mid 2000 or so, and before that, it was something that was quite common in some jurisdiction. And so, right now, as I can see it, there are some of the jurisdictions that have imposed on companies to go and convert all these bearer shares, but there are still legacies out there. Hopefully, over time that it will reduce. It will take some time for that to go away, and also with the financial institutions imposing that, if you have bearer shares, I'm not going to bank you. It helps to drive it faster, because then customers who have bearer shares in their company would start to actually look at how they can convert all the bearer shares. And yep, so Chinyap says to simplify the identification, who is the PO, the beneficial owner regulatory authority has required the company to maintain the beneficiary uh, ownership register. Do you think this will solve the identification process of beneficial ownership? I think in certain parts of the world where this is a very robust process. Say for example, in Singapore we have the ACRA, which is equivalent to the company house in or any other names in other jurisdiction, is where it's automated and it does make it much easier. But not all jurisdictions will have their uh, BO register in digital form, and so when it comes to having that manually uh, updated, it does pose some issue as well. But again, this is something that is happening over time, and with technology is evolving. And for those companies, especially in some of the jurisdiction where companies were formed hundreds of years ago. So it will take time for all this to be converted and to be transformed in to be digitally transformed. So Rajas, I can't remember where I sorry, I missed this question earlier. What do you mean by control other? Uh, hang on, let me. Okay, so let me yep. So yeah, Rajas.
Thank you. Thank you, Julia. Um, one concern that, as a FIU supervisor, one of the concerns for reporting entities, you raise a valid point about beneficial ownership. The March amendments to the FATF requirements, beneficial ownership, you can confirm beneficial ownership by transaction. When you can't find the ultimate beneficial owner, you need to look at who's conducting the transaction. It is deemed the person conducting the transaction is the beneficial owner. This is a new change to the FATF requirements. Reporting entities can get caught off guard with this. As supervisors, we are vigilant because we try and educate our reporting entities to look at these revisions of the FATF standards. Thank you.
Yep. I agree with you, and I think as the FIU, you want to try and educate the people to be able to do it. I think the one of the challenge is that this is why I feel that having that ongoing engagement and communication is so important, and to help them to understand the why. When we put the document in front of them, people will read sometimes just like, okay, yeah, and then they ignore it, right? So implementation and execution would be key, and that comes together with communication. And we just want to continue to have this shared to explain to the people why we need to do it. And so the continuous training has to happen as well. Thanks for the comment, Rajas. So, right. So, I wanted to actually talk about customer risk assessment and rating, but and perhaps we'll take a 5 minute break and come back at in 5 minutes so that we can continue with the uh, the session. Maybe you want to have a comfort break, or anyone. I want to also give opportunity for people who may have questions to ask during this time. Before I ramble on, 5 minutes. So 5 minutes break, everyone. Yeah. So then if anyone has any questions during this time, please feel free to ask as well. Okay, welcome back. So, can I maybe get a show of hands? Who's back? Yes, hi Rajas. Welcome back. Let's see. Is everyone hi Chinyap? Any questions so far from everyone? So Chinyap has this question: how is the beneficial ownership identification for legal arrangement different from a legal person? Different for legal person. Perhaps I don't quite understand your question. Perhaps I could ask you to unmute yourself so you can you can actually explain. I mean basically, uh, I am unable to unmute
Can
you.
you hear me? I'm Chinya. Can you hear me?
Oh yeah, yes.
Okay, actually, I'm sorry because lately, if you look at FATF, they come out regarding this legal arrangement.
Mm,
Because legal arrangement normally we're referring to trust and those trustee, right? And usually when you look at the identification of BO on the point of legal arrangement, they have more than one, a lot of level to go through. And sometimes we find that a lot of banks, some of the banks who is actually small, usually they have this trustee actually open account with them.
mm.
So I just want to make sure that we are at the right path when we look at beneficiary ownership identification, because when you look at a company per se, besides look at the shareholders and shareholdings, of course, the time we are talking about the power of influencing the authority itself, because when you identify VO, it must be a natural person. So when it comes to legal arrangement, how are we going to look about it? Because there are so many, they're trustee, they have not a lot of level there.
Yeah, actually, legal arrangement is a very, very complicated topic in itself. Say, for example, when you have a trust, right? Do you look at it from who do you want to do your due diligence on? Is it on the settler? Is it on the beneficiary? Um, Typically, I would say the settler because that's where the funds are coming from, right? So it really depends on the kind of arrangement itself. And is it the trustee who has the full say? Who exactly is the trustee? And I think in the trust environment, I feel that there are a lot of instances where there are a lot of instances where we because like you say it can get very complicated, and how deep do we go, right? So then we also look at whether the trustee is regulated in a what we call a low risk jurisdiction or equivalent jurisdiction where they have higher standard of in terms of due diligence, and also when they get impose a higher level of due diligence, we get more comfort from there. So it's kind of like a risk-based approach. And then the other concern that we have is that legal arrangement, there could be even we could even be talking about nominee directors and all that, whether or not they actually have a say in some of the activities. And sometimes you may not know that there's a nominee director there, but actually there's somebody whom he's acting for, or he may be holding shares on behalf. So these are some of the challenges that we face. So again, it comes back to documentation. So documentation and record keeping is very important, because then you would be able to say, this whatever that decision that we made was at that point in time that we knew about the knowledge that we had at that point in time. Hindsight is always, yeah, we could have done better, right? So that's where the transparency is. And in fact, there are a lot of all these companies that were set up as special purpose vehicle to hold certain assets. So these are the special purpose vehicle, and most of the time set up by what do you call, um corporate service providers, company secretaries, and all that, I've actually come across a. I mean, in the good old days before we knew about all this CSP and stuff like that, is where we were screening the directors of those corporate service provider, and we realized that, hey, this corporate service provider is everywhere. And then we started to dig deeper in, okay, this is actually just holding on behalf. So who is the actual beneficiary? Who is the principal? So this become a question of not just looking at the document on the face itself, but asking the questions. So I see quite a few of I see a few people asking questions. So let me go to Zanabel first. Um, I
Oh,
Yep.
hello.
Hi, hi
Yes.
Zanabel. Is that how I pronounce your name?
Yes, correct.
Yep. You have a question?
Oh, no, no, no.
Oh, okay, okay, okay. Um, okay. Rajas, let me unmute you. Uh, Rajas, you have a comment or questions?
Sorry, I think I raised my hand. It hasn't been lowered. It was before the break. Sorry about
Okay,
that.
okay. No worries, no worries. Well, I'm always very I'm always very keen, to hear your thoughts because so far I think you have actually shared some really important insights as well. Okay,
Yes,
so
I can comment on that question, how the identification of legal arrangement different from beneficial owner. Legal arrangement, these are trust, corporations, partnership, etc. However, the beneficial owner is a natural person. It cannot be a legal entity cannot be a beneficial owner. It's simple. You need to understand the difference between the two, and therefore, the ultimate beneficial owner is always a natural person.
got it. Thanks, Rajas. Okay, so let's move on to customer risk assessment and rating. So there was a question again. I mentioned that in the survey that how do we actually do the due diligence without just over checking. So this is where the risk-based approach comes in. And what I think typically when it comes to when we talk about customer risk assessment, these will be the prior the this will be the factors that we look at: the client risk, what type of client it is, whether it is an individual, whether it's corporate, it's state owned, so on and so forth. And then we look at what are the sources of funds and wealth and funds, whether they are verified. And then the regulation status. So regulation status means, are they regulated by the say for example by the central bank, like the banks or the financial institutions and all that. And years in operation play a very important part as well, because though generally we tend to see the ones that are new to be of a higher risk, not just from a credit perspective, but also we want to know that this is like the company actually has history of doing transactions, rather than it could be just set up for a specific reason like laundering money. And then certain industry would have higher risk than others. Say for example, what kind of industry that would be potentially more of a concern? Could it be quarry? Because when it comes to certain goods like um uh commodity trading or scrap metal. So these are some of the activities or the industries where it is very hard for us to be able to value the goods, and that's where the trade-based money laundering can happen. You can have the over invoicing, under invoicing, the and when there's no market price that you can actually determine on it, is where it is much easier for people to be able to make use of this kind of product to be to do to launder money. and jurisdiction risk. So there are some countries of so you want to look at it from the country of incorporation and country of operation. So there are quite a lot of times when countries are incorporated in certain tax haven or these jurisdictions also because of tax reason, right? While the actual country of operation or the controlling is happening in another country. So we need to look at that kind of risk as well. So it could be a company, a fund that is incorporated in the Cayman, but the fund manager is sitting in Hong Kong. So that is the kind of thing that we look at. Again, I have no answer to whether you should look at which one different, which one should be higher risk or which one is not, because that again comes to risk appetite and what information that we have to be able to give us the justification whether a company or customer is of a high risk or low risk. And delivery channel risk, I think now it becomes even more concerning is because payment is getting faster, and we know about all these fraud and scams that are happening at a fast pace as well. So delivery channel, what kind of delivery channel you have? It's all online now. You use app, you use internet, and then you have the various other, in the crypto or a virtual asset world, you have the P2P channel that we can't even detect the the peer-to-peer transfers that can happen without us being able to even track and monitor that. So then you have the product risk and what kind of products. The product that we are talking about is different from the industry or sector risk. Here is talking about the product that the financial institution is offering. Like for example, if I were a bank and I offer a product, there's certain product that may be from a perspective of a credit would be high risk, say for example overdraft or lending, that will be high risk from a credit perspective. But from a from an AML perspective, potentially, I'm not saying that it's totally low risk, but it depends on how the customer is making use of the product as well. Could they be borrowing uh borrowing just to show that they are borrowing, and then after that they basically is form of an integration. So and then of course, when it's a cash rich customer, in the past we used to say that, oh, we don't have to worry about the customer is low risk because they're flush with cash. So my next question is, okay, they're flush with cash, so where's the cash coming from? So that these are some of the what I would say that these are some of the balances that financial institutions now have got to bear in mind, is that there are various kinds of risks that come into play, and how we are able to look at a customer more holistically. So after all this risk assessment that we have done, overarching, you have your PEPs, your sanction, and your adverse media. That's where you screen your customer to see whether they have that. And with potentially with PEP sanction and adverse media, chances are you will have to rate a customer higher in terms of risk. And okay, so this is a PEP tip. Normally, we would want to do enhanced due diligence. Can anyone share why? Why do we see PEPs to be high risk? Anyone like to answer the question? Maybe in the chat. Why are PEPs considered to be concerning? No one wants to answer? Anyway, yeah, so perhaps politically exposed person, generally it is because they have the power to, um, if they could be induced and they have the power to make something happen. They have specific position to influence, as Jim said, they have the power to influence. So sometimes it is actually quite difficult. Now, I wouldn't want to say just politically exposed person anymore, because there are a lot of people that may have this undue pow power to influence as well. So say for example, Bill Gates, he is not is he politically exposed? Do we consider him as politically exposed? So these are some of the concerns as well. And say for example, Lau Tek Joe. Joe Lau, as we call it in this part of Asia, is uh very famous for one MTB. He was initially not even identified to be a pep, but eventually we knew that he was actually the person behind one MDB, and because of his close relationship with the then Prime Minister Najib Razak. So these are some of the concerns, and a lot of times is all these officials that the ones that and they are able to actually move money around, and if we are not careful, we are going to be the ones to allow them to launder the money that they gain from corruption. So like for example, I mean there are quite a lot of countries in that or a lot of banks that have been caught because of the one MDB, where uh, billions of dollars were actually moved, and some banks even lost their licenses. So that is how serious the PEP situation is, if we do not handle that. Yep, that's right. They have high influence and control to be able to do something that normal people like me cannot do. And PEP. So what would be the concerns, or when do we assess them? So there is this concept in the past called once a PEP, always a PEP, right? And once you are deemed a PEP, what we are now seeing the trend moving is that we don't want to say PEP, once a PEP, always a PEP anymore, because some people are only while they are in the position that they have the power to do or to make a difference or do or to influence. But then again, once they are not in power anymore, they may no longer have the kind of influence. So again, it comes to having to assess. Uh, each of these PEP would need to be assessed to see whether they continue to have the power or what kind of power they have. And I know that in some jurisdictions they do not consider local PEPs to be high risk. Only foreign PEPs are high risk. So it's it really very much the criteria and the risk appetite that we have in the organization, how we define it. There's no one size fits all. It depends on the organization. It depends on the size of the organization. It depends on the kind of customer profiles that we have. So whether or not we have enough information, if this information that we gather will be what will help us to determine what the level of PEP is. There are some vendors that that have come out with the PEP table, as I call it, is that they have different levels of PEP, and which level of PEP will require further due diligence. I mean, they do recommend that. Say PEP 4, PEP 3 would require certain level of due diligence. And I believe a lot of organizations, a lot of financial institutions do that as well. So if you are a PEP 1, you may not need to go through a certain kind of escalation or approval process. And when you are PEP 4, you may need to go to the reputational risk committee or or compliance committee to approve onboarding the PEP or continue to maintain relationship with the PEP. So that is on the risk. We also do risk categorization for PEPs. Yep, correct. Chin Yap also mentioned that the scope of PEP definition is wide. It's not just the actual PEP, and but also the people that are associated. So then, when it comes to people who are being associated with PEPs, right? This is where you have a very it is kind of difficult. So when you see a person that is constantly playing golf with the president, then I think you would naturally know that this person is a PEP. Um, but if the person is not normally, like for example, Jolo, he was always seen in public with Najib, then therefore, I mean, we should have classified him as a PEP. And but there are some that may be at the back end you wouldn't know about it. So that's where I think while we talk about the definition of PEP, it does become quite challenging for us to be able to see it. And and that's where we go back to the football field. where you have the forward, you have the defender, and then you have the internal auditor, and then the forward is the one who actually can see the goal better and or see the customers better or understand the customer so that they know exactly whether or not what to look out for. And to me, the frontline training is very important, and the frontline engagement is very, very important because this is how we are going to be able to uh, manage the risk. Because if the front line is not familiar and there is what I would say, they just don't really care about it, and this is where we are not going to be able to manage the risk. Yeah. So David, yeah, actually Joe Lau wasn't. On hindsight, he should have been classified as a PEP. I do not know whether the banks had. I believe some banks did classify him as a PEP, and I am aware of a couple of banks that have actually that I know the head of compliance that actually turned down onboarding this fellow because they were uncomfortable with his close association with the president, or sorry, with the prime minister. So. Uh, it's not it's just a lot of anecdotes that were going around about, oh yeah, he actually came to the bank and asked to open an account, and I personally declined him because I wasn't comfortable that he had close relations with the prime minister. So I think on that note, I think it really depends on how vigilant the compliance team is, or how well the compliance team or even the frontliners uh, know the customer. And in some instances, it could even be the relationship managers felt really overwhelmed by the VVIP status of the prime minister that they just went ahead with onboarding the customer. I hope that helps, David. And then, right, and then, yeah. So, what's your view? Anyone would like to share your thoughts about once a pep, always a pep? What's your view about that? Any of the say Cook Island, anyone who would like to share your thoughts about pep? So as I mentioned earlier, I think that I don't agree with once a pep, always a pep. But on the other hand, we need to first assess whether the individual can be de-pep. Yeah, this is a terminology that we use when it comes to, okay, we don't want to make him a pep anymore. Because if you have once more is about risk-based approach. Do we want to treat everybody a pep when the person doesn't hold any position or doesn't have any power to influence anymore? So, and it's quite interesting that I had this conversation with one of my mentors. Is actually on this. Um, it was quite some time ago. I was in Dubai, and we had a client, and he was the son of a minister in Libya. And the thing is, yep, because he's the son of the minister in Libya, then we would classify him as a PEP, and then in a high risk PEP too. And then after that, we say, but the father has died. So, given that the father has died, do we still say that he's a PEP, given that he's no he no longer has power through his father? But on the other hand, yeah. So of course, my mentor said that you first have got to you have got to do a risk assessment on this person, um, and the estate of the late minister, whether he has actually passed on all his assets and his associations to the son. And that is probably the most challenging thing to do, is to assess whether the son has taken on the assets of the father as well as the relationship. So it is really, really a challenging one. I wouldn't say it's easy, And again, it is very much to do with judgment. And documentation is again important. It is the knowledge that we have at the point in time when we made the decision. Yep. So Melita says that she agrees that once a pep, always a pep, because they will always have connection. You're right. Like the we mentioned about the Libya case. We need to assess whether or not the person still has connection. Um, I mean, even though the father has died, does it mean that he no longer has the power to influence, or he's not having the he is not he has not inherited the father's estate? Yep. And name carries weight in most jurisdictions. Yeah, so depends whether or not it's a good thing or a bad thing. The name itself, when it's a VVIP, some of us may get a bit taken aback and say, okay, okay, whatever that he says goes. Um, yep. And sanction, what is your risk appetite? We know that the OFAC does impose a lot of sanctions, and while some of the jurisdiction just follow the UN sanction, and rather loosely the OFAC, and then the EU has different sanctions. So what is your risk appetite? It I this is this is almost close to a legal topic, and so it really depends again on the risk appetite of the organization. We did see instances where of course, when you have all these products that have all the customers that have got the license from OFAC to do the transaction, that's different. Uh, but you also have where there is a mix of products. A customer may be having a small, maybe 5% exposure to sanctioned country. Is that a zero tolerance for the organization, or are you okay with the certain or giving a certain threshold? So what exactly is the risk appetite of the organization? So it's not. I do know that there are organizations that do not have a zero tolerance, because they say, okay, for this particular customer, they do have a 5% exposure, and we are okay with it. For as long as my for as long as they do not transact those transactions through my system, because as far as that is concerned, it's zero tolerance. But the customer having those transactions, I'm fine. Just don't transact them through me. And that, I think there's a lot of all these transactions happening as well. And I mentioned during the last event about government to government transactions. A lot of all these could be G2G related, and so there would be certain specific arrangement that is from a central bank to a central bank um, arrangement that it doesn't touch the banking system, and I shall not name what they are. And adverse media, this is where how do you assess adverse media? When do you see adverse media as being material to onboard the customer? Because someone who was arrested and charged for drunk driving, generally we don't consider them as adverse media that is material enough for us to not onboard the customer. But if he's what about someone who was previously charged for murder? What about someone who was previously charged for fraud? So these are some of the and how we would assess whether is a company, or the customer is somebody that we will want on board or maintain. It would really depend on how we assess the adverse media. And I know I realize that nowadays it's even easier because you have the social media. Whether or not it comes from a credible source, again, we have got to be very careful, because and also the agenda behind it. I recall I had a colleague in Africa where he is very, very familiar with the region, and we did see quite a lot of as adverse media about a particular person, and he was able, because he came from that region, he just said that, oh, these are all politically driven, and I would not take this seriously. So the local knowledge itself is very important. People from outside, we will not be able to really assess it, but if we can have people who have the local knowledge to be able to share the insights from in the country, that would be really helpful. So say for example, if somebody in Cook Island, you are onboarding a customer that has adverse media out from say from Africa, right? And would how would you want to assess that? It would be good if you have that kind of uh, connection or someone who has the local knowledge who will be able to impart that insight to you, whether or not this adverse media, because I mean, the local newspaper, how credible they are, whether or not they are controlled by the local government or any particular individual or party, we would know. So it is the local people who would be able to share with us. Of course, on the adverse media front, this is where the name screening, ongoing name screening is very important. I can share from my personal experience about customers of ours that were onboarded and had no issue. And 2 years down the road, during the name screening, his name was actually flagged out as an alert. And on further deep dive, we found that he was charged for to, as a money mule. And names and all that were there, no pictures, no other identity that would be able to help us to justify. The only thing was name and the age. But then we reach out to the authorities to find out because this was quite serious, right? Because we being somebody who was charged for money muling. So we reach out to the police to find out whether this is actually the same person. And yeah, it turned out that it was really the same person that was our customer who was charged. So that's where the ongoing monitoring is extremely important. And in fact, sometimes it's not just about adverse, but about just media in general. And one of the things that I thought was quite interesting during the heyday of Najib Razak, was that uh, was that it wasn't adverse media. It was just tabloid news, and where the Rosma, who is Razak's wife, the the first lady then, she offered a pink diamond for exhibition, and it cost a few $1 million just for that pink diamond. And then people started to make a lot of started to question, where do you find the money to buy that pink diamond? So again, this ties back to the corroboration of source of funds and wealth. Her answer to the public was, "Oh, I know. I saved all the money. I saved the money from the time I was a teenager until now, and I'm able to buy the diamond." Does it make sense, right? And it comes back to, it wasn't adverse media, but someone should have at that time picked it up and say something is not right. But no one said anything about, no one actually questioned it at that time because she was the first lady. So these are some of the things that when we see, when we read the news media, adverse or not, for people who are in our profession, I think we tend to should have questioned more about that as well. And yep. So yeah, David said, adverse media seldom has the acquittal attached, just the accusation. Yeah. So normally we are not able to see that at all. And in fact, it was just 2 weeks ago, I had another case of there was news about the person being charged 2 years ago, and the person was supposed to be in jail for 13 months. But the thing is, I also noticed, I mean, he he applied for to open account with my company. And to me, I am curious to know whether if the person was in jail, he wouldn't be out here applying for a bank account, right? Um, but I don't know. Well, I don't know what happened. It was just the news. But what happened after that? But the good thing was in the news there was a picture of him, and so we could match that this was actually the person who was charged for fraud, and so we declined onboarding the customer. When it comes to all these checking of documents and checking of news, it has a lot to do with the judgment itself. Yeah, the age actually highlighted it during that time. I think the first time when it appeared on it was uh it was on a tabloid when it first appeared, when people were questioning. So I think the age subsequently picked it up, and of course the age did get into a lot of trouble for questioning the one and DB as well. Um, alongside being banned from publication for months. Um, yeah, David says we have one former president in the USA. He is a PEP. He has adverse media. He's a fraud. He has many charges against him. Yep. And still banks are supporting him with hundreds of millions in bonds, and the reward appetite wins. You know, actually, David, I think this is where I'm gonna sound a little bit controversial here. Sometimes when there is too much at stake, right? When the person is or a company is too big to fail, generally, like what happened with in during the Lehman Brother time, is that when the banks were too big to fail, the government had to come in to bail them out. I think it's a matter of a too big to fail situation. So, yep. I also flashed this slide in the last session on the new payment method, and I wanted to specifically touch on nesting as well. One of the big concern with correspondent banks is that nesting. So if, say, for example, I'm a correspondent bank and I am not onboarding any uh a particular customer because I feel that this particular uh money service bureau or MSB or fintech is of high risk, and I do, or maybe most banks do not want to bank with this particular fintech, right? And or this sector of fintech. And so what do? They go and open account with a bank that would bank them, with a bigger risk appetite to bank them, and this is what caused a concern. While I am not allowing I am not onboarding the customer, but my FI customer is banking that particular customer. So you have that nesting effect, and this is where transaction monitoring nowadays is able to pick up. And in the good old days, what we used to do, good old days means less than 10 years ago, actually, when technology was not so advanced, was when on a monthly basis, what I used to do was that I will have a download of the transactions of all these correspondent banking relationships that I had, and I will do a name search on the transactions where it may flag out any particular financial. It may say a bank, it may say a co-op or corporation and all that. I would do a name search on the sender and beneficiary information to see whether there's any potential nesting in there. So it was that painful. Now it's much easier. Well, that is less than 10 years ago it happened. And the danger of this is that when we have those situation, you don't know what, when you have the financial institution behind a financial institution, is where while you are comfortable with the respondent anti-money laundering program, you cannot be too comfortable with the other financial institutions that are, whether or not they are doing the proper due diligence on their customers that are using their system to come to you for clearing especially. So nesting is always a concern, and all correspondent banks are very careful about that. So let's have a discussion, a breakout. I thought that I don't know, maybe 10 minutes is too much. um think about this. So looking back at the nesting. So being a company, a crypto exchange approaches your bank to open an account. And the whole reason for the crypto exchange to open an account with you is to avail themselves to US dollars. And you are a respondent, and say you have a relationship with a correspondent banking for US dollar clearing. So maybe you can shout it out. You can let me know. You can shout it out, or you can put your hand up, or you can put it in the chat. What are the material risks that you see, and what would be your consideration to decide to onboard the customer or not? Any first thoughts? Any initial thoughts on that? Let me mute myself. So, and a crypto exchange approaches your bank to open an account. What are the material inherent risks and sanction risks that you believe would be there for this particular sector of customers? And what would be your considerations to decide to opt? Yep, thanks, Rajas. And yep, are they licensed and registered appropriately? Amy says. What other considerations? And I think when it comes to being licensed or registered, we would also want to see where they are licensed and registered as well, because there may be some jurisdictions that are more stringent in terms of their AML program as compared to others. So when they're licensed, also where. Any other any other thoughts? So what exactly would a crypto exchange have? They would have retail customers, they would have corporate customers, and it's let's just talk about a very simple crypto exchange with no plain vanilla products. I mean, they're all plain vanilla product, just trading. No, nothing too complicated. So in the case of I believe in the Pacific Islands, none of the jurisdiction ban crypto, right? I am not familiar, but are there any crypto exchanges in your jurisdiction, or any crypto exchanges that are licensed in your jurisdiction or present in your jurisdiction? So crypto exchanges are typically, I think that in a lot of banks, there is a challenge for crypto exchanges to open account. I think I don't think they are. I don't think they are all bad. It's just that we will need to put in a lot more due diligence process into it. So first, we already know where they're licensed, and then after that, we want to know what kind of customers they serve, and what kind of product that they do, what kind of channel that they do, and of course, most important is what kind of AML program they have. How robust is their risk assessment process? Yep, and their UBO. That's one, and yep. And then what kind of I would say what kind of product, and how do they do the transaction monitoring? How do they take in all these how many hops they call it, when they do the blockchain analytics, do they have such a process? And then of course the one area that we want to think about is also the product that we offer them. Is it to offer them an account to operate their day-to-day operating expenses, like paying the staff salary, just like with a casino as well, do we consider that as a concern if any of if it is an operating account that is paid for paying staff salary, operating and all that, right? As compared to making use of the account for their customers. So that is kind of like a correspondent banking in a different world, in the sense that it is not a bank, but it is a crypto exchange that is making use of your uh, e- infrastructure to do transfer of money to somewhere else. So it really again depends on the product that we offer. So if it's operating account, perhaps it is not so high risk as compared to, having the they are making use of the bank for them to be able to manage their customer account ledger. So when they are managing the customer account ledger is where you will have a concern. Do I know who the underlying customer of my customer is, right? The end customer, how do they do, how robust is the due diligence process? And yeah, so Chinyap, I see you say you would consult compliance on the risk exposure before making decision. I think in a lot of I think in a lot of banks, when it comes to any of such new payment method or fintechs, they typically would have a committee or a special group of specialists that will assess all the risks before they do the onboarding. So um being from a fintech is I have actually experienced very painful process of being onboarded, because they had to go through a committee to review the risk that the fintechs are potentially posing to them. So any other particular things inherent, and of course, sanction risk is also real in the crypto space. How does this crypto exchange also assess the sanction risk on the side? Do they have the controls in place from in their blockchain analytics to be able to identify those? So what other things? Yep. And yeah, I think when it comes to the crypto exchange, is also who is behind that exchange. There are a lot of exchanges out there, and some of them we would want to understand who the ultimate beneficial owners are. Yeah, controversial here, Chinyap. Can we trust them? Is they said they have but not implement them, as in the case of finance. Yeah, we are constantly following the news, and also the case that is currently in the report on finance um, suit in the US. And it's quite interesting to follow the whole journey of where they were until where they have come to today, and how they have actually put whether or not they have put the controls in place. Sometimes when they say that they have done it right, I can very easily say that I've done it, and yes, I've done it, but whether I have done it correctly, it is really up to us to decide whether it is about being effective. So technically, yes, I tick all the boxes, but how effective it is, I think in the world, in the digital assets world, with the innovation and with all the changes in technology, I would admit that as a compliance officer with not much of tech background, I do find it very, very challenging to follow the technology. Basically, I'm running after technology all the time. So, and I think in on that front, now we can no longer work in silos, work in our own little team, but we need to start talking to people from other parts of the world, from other departments, so that we are able to work collectively to manage risk. Yeah. So in terms of yeah, technology, really it is the biggest challenge. And I see Anthony has raised his hand as well. Yes. Yes,
Hi.
Anthony.
Good morning. Hi, Julia. Can you hear me?
Hi, morning.
Hi. So I think that Yeah, it depends how you look at this question, right? But if we take a few steps back, we have to think first about whether the institution that you're working for has, this considered properly, from a new product perspective, whether or not its infrastructure has been well built to support such a business to begin with. You don't want to onboard one exchange and then, you set up everything and you can't make money out of it. But I think beyond this, let me talk about consideration. I think beyond this, you got to think about, you know, if you open up, like, say, clearing, right, for the exchange, you basically open up your books to, in the past you talk about correspondent banking, you're just dealing with just one respondent in one location. You roughly know what is it all about. If you put it to an exchange and, you can't control where, the starting point is, and if they do onboard clients all over the world, you technically can clear for everyone in the world and you open up your exposure. So I think that's where, if I look at it very high level, you tend to think about crypto exchanges as something that you want to really consider first. I think the earlier part about regulation or where is it regulated is important because in my understanding, I think, like, say, even in Mongolia, in different parts of a bit more far flung out, they are regulated, but do you really want to accept them, as an exchange, or even from the extension, correspondent banks actually banking with this with these exchanges as well. And I think you really made the point, which is correct. Sometimes you said, don't pass the flows through to me, but that's really a risk appetite angle. You don't even talk about whether you want to open exchange. I mean, if your respondents has an exchange relationship, do you want to say that, please don't pass the flow through to me? So, I think I threw out a lot of considerations here, but, if we want to be really technical about it, then yes, you would consider infrastructure, framework, travel rules. I think to your point about assessing the AML controls of the exchange, but then the thing is, exchange is not, if the exchange is your client, yeah, you can do that. It's also, but then, how technically sound are you to know what you're going to do with the exchange, and what's the products you're giving to the exchange, right? Just clearing, or you want to do something a little bit wider and say, what, I can do a GT or financial markets transaction, if you do derivatives, and make it more complicated. So I think a lot of things I threw out here, but one thing we have to really start out by saying is that, is the financial institutions I'm working for ready to accept such a business? Have we considered, all our infrastructure, our controls? Have we set up ourselves for, understanding the whole ecosystem, or not losing any missing piece of the model of the exchange coming through to us, right? Because I mean, the exchange themselves could have their own liquidity provider, or bring in other bad actors, or unintended actors, not bad actors, into your system. And do you really want that? So yeah, sorry, Julia, if you can summarize that, that'd be great.
I really love your comment, especially on the part, number one consideration. Do we have the infrastructure to manage it, that risk? If we don't have if we don't have the infrastructure to manage it, you can forget about onboarding this customer. As I shared earlier about how we used to assess whether there's any nesting happening in our ecosystem, was when I had to do a name search monthly to see whether there's a name of a bank, or there's a name of any fintechs or whatever that is in the transaction data. Oh, it wasn't fun. So having the right infrastructure is the number one consideration for sure. Thanks so much, Anthony, for your input. I really love that. Anyone else who has any input or to share as well? Yep. So yeah, Chin Yap again is that your bank is not using any advanced technology in monitoring. It's better not to onboard. Yep, correct. True, true. Yep. And yes. So Um, I think my timing is perfect. So we talk about the organization roles in effective customer due diligence, and I can't emphasize this enough. Is about having that robust enterprise-wide risk assessment and internal control framework, which is one of the modules 2 weeks down, and then the risk governance and control environment, including the 3 lines of defense. Now, risk governance here I would also like to again remind about documentation, about having the right authority level, and the risk governance also talks about the skill set of the people that are going to be doing the approval. In fact, now there is there is an expectation from the regulators in a lot of jurisdictions that, especially in the fintech or in the financial institutions, is that there is someone sitting on the board in the either in the audit committee or in the risk committee that has some technical background. Uh, because this is becoming especially from the technology risk management perspective, this is getting to be more and more concerning if the board is signing off on something that they are not familiar with, and the board is going to be held accountable for it as well. So that kind of a risk management, it has to be very holistic. And then effective customer lifecycle governance framework. So when we talk about right, when we always talk about customer due diligence, right, it's actually we don't look at it in silo. I always call it from cradle to grave or womb to tomb. Is where you start from onboarding, customer selection, not just onboarding, but you determine whether or not you want to onboard the customer. So onboarding start, and then you have the life cycle where you would be screening the transactions, continuous screening of the name, continuous monitoring of the transactions, and then all the way to the end until we exit the customer, or the customer exits us. And then the most important is to have an effective communication and training program. And I always like to use this quote from Warren Buffett, that everyone must be his own compliance officer. You see the small c and the small o, and it means that everything we do has to be, it's not just the compliance department with the capital C that is responsible for it. So I cannot emphasize enough the importance of having a robust compliance culture, risk culture within an organization. And this is something that a lot of us can do together, is actually uh, wanting the desire to do the right thing. And then, when that one goes across the entire organization, and then building that communication channel, the open communication channel across all three lines of defense, that's what is going to be the most effective way to manage risk, whether or not it's a financial crime related or it's credit. And end of the day, it's all about being um, aware. Just like even training to help people to be aware that uh, Jebel Ali is just a few hours boat ride away from Bandar Abbas. That kind of conversation is a conversation, is a dialogue, is an ongoing is an ongoing do you see it yeah, ongoing communication. That's that would be that's how I would say it. um I think that I go back to the survey which I flashed out earlier. So I felt that maybe in today's session we are able to tick off, how to apply the best practices on conducting due diligence, and I would say it's risk-based approach, how that will determine the amount of due diligence that is required. um, I think the type of risk associated with correspondent banking, we did touch on that, what the correspondent banks are most concerned about. And then, yeah, there are two questions here on the nesting. I kind of like touch on the nesting. So, Anthony also mentioned about, I deliberately have used the case study of the crypto to also bring up a point about the concern with the nesting at the back of it. I hope that was clear. And if there are any other burning questions, do feel free to pop them into uh the parking lot, so that we can take it forward in the next session, and I can build that in as well. And then yeah, despite, this is where we say, despite them having policies and procedures, what comfort level are they abiding by it? So they here, I am guessing we are referring to the respondent banks. Yeah, good question. So this is where the hopefully we are able to get audit reports from them as well, which is one of the question in the Wolfsburg questionnaire, about whether or not they have a frequent internal audit, external audit, can they share their audit report. So yeah, compliance, while it is a moving target, you can see that as far as the client life cycle is quite standard. You will have the onboarding process, the identification, verification, the screening, the transaction monitoring. That has, in as far as I remember, not changed at all. The tools may have changed, the method of detecting would have changed, but in compliance itself, as far as the client life cycle is concerned, I say moving target, yes and no. Regulations change, but the structure of this client life cycle has not changed. And yes, rising cost of compliance. I think this particular quote has been over quoted. Is like, if you think the cost of compliance is high, think about the cost of non-compliance. Now the regulators are coming down hard, enforcement actions and all the fines that are coming in, that is making a lot of the banks very wary about correspondent banking, especially if they do not have enough information of the underlying customers. So, questions. And if you have you want to again, if you need to have any questions, this is open until the 21st of March. So do feel free to pop in to pop in if you have any questions during the week, so that we can look at it together. So let me know if you need to have the if you need to have the link again. I lost the link. So right, and I have listed down the resources here for your reference as well. And if there's any during the week that I come across, I will just pop it into the resources. This is a refresh set from the last one that we did. So okay, so there's one person who asked, when do you as a regulator draw a line on the riskiness of the client being onboarded by a FI who has a high risk appetite, and how? Okay, so I think, when it comes to I personally have not been in I would say that I have not been in the position of as a regulator before, but I can say that from dealing with regulators is that I think first, when we deal with the regulator, is transparency, is having gone through some of the monitor questioning, is like to explain to them why we do what we do. This is our risk appetite, this is our parameters, and yes, we have a very high risk appetite, and this is how we have assessed. So documentation is very important. I still remember one of my relationship managers during that time, um, good old days again, where uh, his file was being picked. His file was picked, and then the regulator, the auditor came and say, it appears that the RM was trying to hide information from the compliance, because the way that he has drafted the approval, or the drafted the background, and the for to request for approval for compliance, the auditor has deemed it to be insufficient for the compliance team to make decision. But then again, and good thing is, this event, this particular email happened 7 years before that audit. uh yeah, don't ask me why they went back so long, but it did. And so they managed to troll all the emails, and they picked up on this particular RM, and they say it appears that the RM was trying to hide information. And good thing that the RM was actually still around in the bank, and we asked him, we said, hey, okay, calm down, walk us through what you can remember what happened. And he said, look, this is what happened. And he actually could remember it, because again, it wasn't just him. And when he sent the email across to compliance, the head of compliance then just had one word: approved. And he didn't say why he approved it. There was no rationale behind why it was approved. So it became a lesson for me as well that when I approve something, I make sure that I document why I approve it. So, when you made those judgments based on the information that you have at that point in time, nobody can fault you for any other thing that happened after. So I hope that answers your question um, when it comes to this, right? How do you justify to the regulators? It's all about documentation. So okay, let me see whether there are any. Yep, I hope that answered your question. Um, yep, Shinyap, as an ex-regulator, usually those institutions having high risk appetite will be under your regular close monitoring radar. Yep, that's correct too. So I have let me again share the link for to the parking lot so that if any one of you has any questions during the week, I already have the slides and the content in place, but I normally pick up the questions if there are any so that we can actually address it in the next session. With that, that's what I meant by co-creating the content so that all of us can actually share the knowledge with each other. And thank you today, for those of you who actually shared your experience. And thanks, Anthony, for bringing out a very important point about, first of all, the consideration is whether or not we have the infrastructure to even onboard that particular customer. So, any other questions, comments? I think I've answered that question. Yep. So I also thanks for your view, Chinyap, on the being an ex-regulator on that your perspective. That's really, really helpful. And thanks so much to the team um, for joining us today. And I see you next week. If there are no other questions, have a good day and a good afternoon and a good evening. Thank you.